Hello and welcome to our budgeting and money management seminar. Today we're diving into the essentials of budgeting, and by the end of this session, you'll have a solid foundation for creating a budget and adjusting it to fit around your lifestyle and savings goals. Let's start with what is a budget? A budget is a plan for how you'll allocate your income to meet your expenses for a certain time frame, a week, a month, a year. Today we'll focus on creating a monthly budget, as most bills and expenses like rent, phone plans, streaming services, and even groceries happen every month. Note that as you get started, your budget may change depending on the month. Life happens, holidays come up, etc. It's important to check in on your budget, stay consistent, and be realistic. Remember, while it may be time consuming to get started, after a few months, it'll become easier, and overall, budgeting could be your key to financial success.
So let's get started on creating your monthly budget. There are 6 steps that we are going to highlight for developing your budget. As you see on page 2 of your handout, you will see the first 2 steps of creating your budget. The first step is determining your income for the month. Sounds simple, right? But let's clarify income. Income is the money you receive on a regular basis, typically from a job, but it also could be things like work, freelance work, rental income, government benefits, and even alimony or child support. When budgeting, we always focus on your net income, or what you take home after taxes and deductions. If you're pulling figures directly from your pay stubs, that net income is already determined for you. Your net income is the number you'll use in your budget to plan how much you can spend, save, and invest. For step 2, consider your expenses, money that is going out in the month. This will include needs and wants. Fixed expenses are needs that cost the same every month. Think rent, car payments, student loans, and childcare. Variable expenses are also needs, but they change from month to month. Think utilities, groceries, and gas. Then you have your discretionary expenses. Those are the wants: dining out, streaming services, travel, hobbies. Having your needs and wants separated will help you prioritize and identify where to cut each month if necessary. Create a list of your expenses. Use your online or mobile banking accounts and credit card statements as a guide to see what you have been spending your money on.
Before we talk about step 3, let's dive into some common budget mistakes. Here are 5 of the most common budgeting mistakes to keep in mind and avoid as you begin your budgeting journey. Number 1, underestimating expenses. People often forget irregular or variable costs like car maintenance, gifts, or annual subscriptions, which can throw off your budget. Don't hesitate to include a miscellaneous category in your budget to possibly cover some of these expenses. Or consider setting up multiple savings accounts to designate for expenses such as holiday gifts, taxes, vacations, and more. At GCU, you can label your savings accounts in online banking to help you stay organized and hold yourself accountable. Another common mistake is not tracking spending. Creating a budget is only half the battle. If you don't track your actual spending, it's easy to overspend without realizing it. Keep an eye on those credit cards as it can be easy to not realize how much you've spent, and try to pay off balances as soon as possible so you don't pay interest. Another common mistake is being too restrictive. Budgets that are too tight or don't allow for any fun or flexibility tend to fail because they're hard to stick with long term. So as mentioned, be realistic and know it's okay to allocate some fun. Another common mistake is failing to adjust the budget. Life changes and so should your budget. Many people don't revisit or revise their budget when their income, expenses, or goals change, which is an important part to keep your budget on track. Lastly, ignoring savings and emergency funds. Prioritizing bills and spending while overlooking savings leaves no cushion for unexpected events, which can lead to debt. Sarah's going to talk more about savings and emergency funds next in step 3.
With that said, let's talk about setting up your savings goals. Set at least one short-term and one long-term goal for yourself. Short-term goals are typically under a year, such as an emergency fund, holiday gifts, or a weekend getaway. Long-term goals are over a year, such as a down payment to purchase a house, retirement, home renovations, or starting a business. Vague goals often don't lead to success and are not as motivating. It's important to use the SMART goals method. SMART stands for specific. What exactly are you saving for? Measurable. How much do you need? Achievable. Can you realistically reach it? Relevant. Does this align with your life goals? And time bound. When do you need the money? An example of a SMART short term goal is to say you want to save $1,200 for a vacation by December. If you start saving in July, that's $200 a month. It's clear, trackable, and time specific. Once you have your goals determined, incorporate your saving steps into your budget. Remember, at GSCU, you can set up several savings accounts to keep your goals organized. You can also set up automatic payments to ensure you're staying on track. And while we're on the topic of goals, remember to keep an emergency fund in mind when goal planning. An emergency fund is a savings account used to cover unexpected expenses like job loss, medical bills, or car repairs. It acts as your financial safety net. A general guideline is to aim for 3 to 6 months worth of living expenses in your emergency fund. If you don't have one, consider making this one of your first short-term goals.
Now, with your net income, expenses, and savings goals determined, step 4 is to apply a structure to your budget. 50% of your income goes toward your needs, which includes housing, utilities, insurance, groceries, car or credit card payments. 30% of your income goes toward your wants, which includes entertainment, dining out, shopping. And then 20% of your income remains for savings and debt repayment, which can be for an emergency fund, retirement, or principal payments to pay down loans. For example, let's say you take home $3,000 a month. 1,500 goes towards needs, 900 goes towards wants, and that leaves $600 towards savings for paying off debt. While the 50-30-20 rule is a good rule of thumb, it may not fit everyone's budget. If your needs are more than 50%, that's okay. If you want to swap the 30% wants to savings, that's great, especially if you don't have an emergency fund set up yet. You can make adjustments to your budget accordingly based on your goals. The purpose of this structure is to help you be more intentional with your money as you work toward your goals.
And now that we understand how to apply a structure to your budget, let's move to step 5, which is creating your budget on page 6 of the handout. Add up all the expenses, include your savings goals, and determine your final budget amounts. Right away, you'll see how well you're doing with your budget, whether you're over or underspending, where you need to make cuts, and how your monthly budget aligns with your savings goals. Now let's look at an example. Using the same 50-30-20 rule as mentioned previously, we have a net income of $3,000, which is made up from $2,600 job and $400 child support or alimony. Expenses totaling $2,400. If you look at the categories, $1,500 of these expenses are the needs, highlighted in yellow, and $900 are the wants, highlighted in green, leaving us with a savings or additional debt repayment total of $600. As you see, there is a spot to add savings right into expenses, but leaving it off for now ensures you are staying within your 50-30-20 structure. Step 6 is to evaluate how you did with your monthly budget. Towards the end of the month, use your Track Monthly worksheet, which is page 7 of this handout, to compare your budgeted amounts to the actual amount spent. Begin creating a budget for the next month. Do you need to make adjustments? Are there any new items you will need to budget for, such as holidays or vacation? Start small and stay consistent with your budget. Like any habit, this will get easier and take less time as you move forward. And remember, Budgeting isn't just about restriction, it's about having the control to make choices that align with your goals.
So far, we've covered what a budget is, common budgeting mistakes, 6 steps to create and maintain a budget, which included determining your net income and expenses, the importance of SMART goals to power your savings, and the 50-30-20 rule to guide your budget, and creating and tracking your budget each month. Lastly, let's take a look at the resources listed on page 8 in your handout. In some ways, GCU might be able to help you further. To work on your savings goals, consider a term share certificate or a high yield savings account, such as a money market. Tracking your monthly expenses is easier than ever. With digital banking, you can monitor credit cards and any other transactions daily or weekly to ensure you're staying on budget. If you prefer, you can also utilize budgeting software or an app like Mint or You Need a Budget to have your budget automatically tracked for you. There are many free or low-costing budgeting tools available, but in the end, monitor your budget however it works best for you. Just make sure you do your research by checking reviews for the Better Business Bureau before downloading any software or apps to avoid fraud, since you will be linking your bank accounts.
If you are struggling with high interest debt, especially credit cards, consider looking into a debt consolidation loan with GSCU. Keep in mind, the average credit card interest rate is now over 25%, according to Forbes. Consolidation rates are usually less than half the credit card rate, so look into what you're paying on your credit cards. If you have multiple cards, a debt consolidation loan could help you simplify your expenses into one loan with one monthly payment that fits your budget. If you're struggling with your credit, visit the credit page under the Learn tab on our website for resources and ways we could help. Whether that's checking out a future GSCU Credit 101 seminar or enrolling in Credit Savvy within digital banking to access your credit score anytime, anywhere. It's free for GSCU members. You can also pull your credit report once a week for free from annualcreditreport.com, which is worth checking out as you work on your budget to ensure your credit history and account use looks accurate. Confirm accounts you closed are actually closed. There are no signs of fraud on your report, and make corrections through the credit bureaus, which are TransUnion, Experian, and Equifax, if needed. And consider setting up bill pay to help manage your bills. These can be reoccurring or one-time payments such as auto insurance, utilities, and credit card payments.
We hope today's seminar provided insight into how to get started with your budget or offered ways to improve it. Remember, you can book a video or in-branch appointment with one of our branch specialists by visiting our website at gcu.org and searching Schedule an Appointment. Thank you all for attending our seminar. We look forward to assisting you on your financial journey. Be sure to keep an eye out on our website and social media channels for announcements regarding future financial seminars.